Let's also bring on board then Tirthankar Patnaik, Director Strategist Institutional Research at Religare Capital. Tirthankar, hi. Morning. Your take on the vote of account. Does it seem like it's a little bit of an aggressive target by way of, the fiscal deficit target, given the macro situation that we're currently in?
I guess more than the fiscal deficit target, it's the tax revenues that are a bit on the optimistic side. Fiscal deficit numbers are generally now over the last 2 years are coming in line with what the government had pointed out in October of 2012 in terms of a fiscal policy strategy statement, where they said that by FY 17-18 they should get 3% fiscal deficit. We believe that's possible, but the tax revenue numbers are on the optimistic side at 18% with 5.3% growth. It will be difficult for the government to realize the tax numbers. Of course, we'll see planned expenditure cuts during the year as the government sees that tax numbers don't really add up.
Tirthankar, whereas the budget arithmetic clearly shows a lot of optimistic assumption both on the revenue side, on the fiscal side, markets I think would still insist that look, this is an interim budget and the real budget will only come when the new government is in place. So let's keep the budget assumptions aside. Let's talk about something where a sector where life will change automatically. One is autos. Do you think excise duty cut for autos is unlikely to generate demand?
See, that is the million-dollar question. I mean, our analyst believes that auto for four-wheelers this year should have around, a volume growth of roughly 8%, and we should see slightly similar numbers for two-wheelers as well. Maruti, we are assuming volume growth of around 10 to 11%. So the important point is with the excise duty cuts that OEMs are likely to pass on, generate a volume growth. If it does, then maybe the government's demand stimulus will bear fruit. Our own case is that we are not changing our estimates given these numbers really.
Tirthankar, the other positive has been lower than expected carry forward number for under recoveries. Would it make you turn bullish on names like ONGC or BPCL?
This still means that there will be a carry forward even in the next year. Purely because of these names, I would not be incrementally more positive. The call, of course, is that the government and the next government that comes in continues the continual diesel price hikes over the next few months so that the under recoveries go down substantially. That will be the call one would have to take. The government has pointed out that it's pushing out about 350 billion to the next fiscal, but then the next fiscal also will have the same numbers, because unless you're looking at a significant drop in oil subsidies, one would not look at an overall oil subsidy number of just 650 billion for FY15. So clearly there is upside risk there. To our call, we believe that oil marketing companies, ONGC, would benefit from lower subsidies if the government continues with diesel price hikes, nothing less.
Well, the bottom line here is that interim budget, which was perceived to be a no event for Indian markets, has turned out to be an election budget, largely because of some sweeteners like excise duty cut. So, Tirthankar, let's brush aside interim budget, because bulk of the price adjustment is already in the price. The credibility of those numbers is still a question mark. Do you think now that the event is over, it could be back to basics for Indian markets, which means focus on global cues, map global liquidity, and talk about macros? Well,
you're right. Basically, the budget part is over, but you seriously didn't expect them to give up without a fight, did you? So there would have been some amount of populism. One should be thankful that the populism didn't extend from where it was actually, where it currently ended up. We are not seeing any kind of fine print in the budget that had spooked investors, especially foreign investors, over the last 2 years in terms of GAR and the other topics. So to that extent, things are fairly okay. But you're right, numbers would shift to the focus would shift back to the macro. In terms of macro fundamentals, most of the underlying trends for India are mapped out over the next couple of quarters. Current account deficit is likely to remain low. Fiscal deficit numbers are likely to remain largely in control. Let's see how tax revenues pan out over the next few quarters. Importantly, you have the elections, and from a domestic perspective, I think the focus would increasingly shift there. A lot of investors that we speak to have pointed out this as a binary event. So opinions are divided. Would there be a rally before the markets, before the elections, or will there not be any rally? And stock picks would essentially depend from there. From a global perspective, clearly we are looking at the Fed basically settling onto its auto taper mode, by which we would mean that by June, July we should have been finished with the taper. So one would remain cautious from an emerging market perspective on as to how these things will pan out on the currency and on capital flows really.
Closing comments from you. In the run-up to the election, what to your mind could be the best case scenario for the Nifty?
The best case scenario for the Nifty could be another 5 to 7% upside from current levels, at which point the markets would basically have factored in pretty much a BJP victory and maybe a number north of 200 to 220. So I would say about 7%
scenario also?
Upside from current levels. Pardon me?
Now, are you also working with the worst case scenario?
Worst case scenario could be a figure of about 5,800, 5,750 or so if the emerging market crisis does get exacerbated, if the outflows that we are seeing from equities do get exacerbated. There's this clean trade-off for India. There is a potential positive trigger in the form of elections, and on the other side, the macro having stabilized, that being balanced off by a taper and emerging markets essentially seeing risk of as the taper actually continues.
Okay, Tirthankar, appreciate your time and thank you for joining us.